Good afternoon, viewers. My name is Imran. I'm a UK and international tax specialist. Once again, I'm here with another interesting video. In this video, I will explain to you how you can deal with the changes in the partnership in the UK. This video is with illustration and example, which will make it very easy for the viewers to understand the concept. I suggest you do not skip any part of this video because there are lots of useful information in this video. Also subscribe to my channel because I'll be making more interesting video like this. I have already uploaded video which covers employment taxes in the UK, corporation tax, capital allowances, partnership. Also, I'll be making more videos on capital gain tax, inheritance tax, VAT, financial reporting, and financial management. This video is related to how you can deal with the changes in the partnership. So this topic is highly tested in ACCA, ACA, and CTA taxation exam. It's also helping viewers how to deal with the changes in the partnership. This video is with illustration, which will make it very easy for the viewers to understand the concept. Introduction to partnership changes. I already uploaded a video which explains how you can deal with the partnership return, how you can allocate partnership profit to each partner using the profit sharing ratio, how you can adjust the accounting profit to arrive at the taxable profit. In this video, I will explain to you how you can deal with if there's any changes in the profit sharing ratio. Remember, with the passage of time, the profit share ratio would change in practice because some partner might be eligible today for 5% ownership of the partnership profit. However, with the passage of time, their profit share would increase to 10% or 15%. Then how you can deal with this one. So in this video, I will explain to you how you can deal if there's any changes in the profit sharing ratio. So from practice side, it will be always like this. Each year, the partnership ratio change. Sometimes new partner joins and some partners retired. I will be making a separate video on this. However, in this video, I will explain to you how you can deal if there's any change in the profit sharing ratio. So note that the basic principle will still apply for the partnership. That is, first adjust the accounting profit for the tax purpose to arrive at the adjusted profit, and then we allocate the taxable profit between partners using the profit sharing ratio. After dealing with the profit sharing, then we treat the partner as individual, because once the partner receive the profit from the partnership, they need to declare the profit on their self-assessment. Changes in profit sharing ratio. So changes in the profit sharing ratio will affect profit allocation ratio partway through an accounting period. If this is the case, this will affect step 2. Remember, if you have seen my other video on the partnership, I've explained how you can deal with the partnership profit. So you start with the step 1. So step 1 is adjust the accounting profit to derive at taxable profit. You start with the accounting profit, you add back depreciation, you add back other disallowed expenses, then you claim capital allowances. Then you deal with the step 2. And the deal with the step 2 is use the profit sharing ratio to allocate those profit from the partnership to each partner, and each partner will declare this income they receive from the partnership on their self-assessment. So if there is a change in the profit sharing ratio, so when it's come to step 2, remember the accounting period usually 12 months long. So you need to deal with the pre-changes and the post-changes. I will show you on the following slide with illustration. So in the step 2, split the accounting period around the change. Deal with each period separately. Use the ratio applying for that particular period to determine the profit allocated to each partner. Then combine the profit from those split period will give us allocation for the whole of the accounting period. I will show you on the following slide with illustration, which will make it very easy for you. Illustration 1. During the year to 31st December 2023, two-partner initial profit allocation was 70-30. The ratio of profit allocation was 7:30. However, they decided to change the ratio to 60-40, and this happened on the 1st of August, so 2023. The accounting profit allocation because of these changes will be, so you deal with the, so step number 1, so we split the accounting period in 2 periods, that is pre-change and post-change. So the pre-change is, remember, the changes occur on the 1st of August 2023. So for the first 7 months to 31st July, So 7 divided by 12 of profit will be allocated using ratio 70 and 30, and then post changes from 1st of August 2023 to the end of the accounting period, which is 31st December. So 5 divided by 12 of the profit will be allocated to using the ratio 60 and 40. So it's very simple. I will show you, and on the next slide, I will show you a much bigger picture. Illustration number 2. Bill and Anna and Sandra are in partnership, sharing profit 40, 40, and 20. In the year to 30th of September 2023, the adjusted profit is 200,000. On the 1st of July 2023, the partners agreed to change their profit sharing ratio to 40, 30, 30. Now, usually happen because in practice, this is very common because some partners working very hard, long hours, or they contribute more and they come up with the different skills and they would be expecting more profit. So with the passage of time, they become senior partner, and then all other partners very happy with them. So this is the case usually in practice. So show how profit of 200,000 will be split between Bill, Anna, and Sandra. In order to deal with the profit allocation for the year to 30th of September 2023, we need to split the accounting period around the change and deal with two periods separately. Remember, pre-changes and post-changes, as I explained to you on the previous slide. So now on the following slide, I will show you how you can solve this problem. To deal with this question, you need to make 4 columns, one for total, one for Bill, one for Anna, and one for Sandra, because there are 3 partners and 1 column for total. Then you pick up the total profit for the year end 30th of September, 200,000. Remember, initially the profit sharing ratio was 40, 40, 20 till 30th of June 2023. So there are, for the first 9 months, the profit sharing ratio was 40, 40, 20. Pick up 9 months profit, 9 divided by 12 multiplied by 200,000, that will give you 150,000. Then split the profit of 150,000 using the profit sharing ratio for each partner. So Bill will get a profit of 60,000, Anna will receive 60,000, Sandra will receive 30,000 for the first 9 months. After 9 months, there's a change in the profit sharing ratio on 1st of July. So for the remaining 3 months, pick up the remaining 3 months profit. 3 divided by 12, multiply by 200,000, that will give you 50,000. Then split this 50,000 on each partner using the profit sharing ratio. For Bill, still is 40%. However, for Anna, the profit sharing ratio changed to 30%, and for Sandra is 30%. So then for each period, so work out the 2 separate periods because they change in the profit sharing ratio. Then add both periods together. For example, for Bill, 60 plus 20 equal 80. Bill will declare this 80,000 on his self-assessment. Anna will declare 75,000 on her self-assessment. Sandra will declare 45,000 on her self-assessment. There could be a complex situation. A complex situation will be there will be salary plus interest on capital. So if there are salaries or interest on capital in the non 12 months period, those annual figures must be prorated as well, the way we dealt with the accounting profit. If there are changes in the ratio partway through an accounting period, we need to look at the period which are less than 12 months. In the previous illustration, if there were salary paid to the partner, we need to prorate them. For example, for 9 divided by 12 of the annual salary for the first period, I'm talking about the previous illustration, number 2, and 3 divided by 12 of the annual salary for the second period. The same will apply to interest on capital. These will only affect the allocation step. I will show you on the following slide how, with illustration, how you can deal if there are salary and interest in the partnership. This is illustration number 3. Simon and James and Lena are in partnership and have adjusted profit for the year to 30th of June 2023 of 230,000. Up to 31st December 2022, the partners share profit equally after charging a salary for Simon of 20,000 per annum. With effect, watch the wording, with effect from 1st of January 2023, Simon's salary to be reduced to 10,000 per month and James to be receiving interest on capital of 40,000 per annum. But this thing occur after 1st of January. This is the decision. If this decision regarding James of 4,000 for the whole year, then the situation will be different. However, this decision occurred with effect from 1st of January 2023. Residual profit now to be shared 40, 30, 30. Initially, it was sharing equally, but now they decided to change this to 40, 30, 30. Now, on the following slide, I will show you how you can deal with this. Make 4 columns, one for Total, one for Simon, one for James, one for Lena. The total annual profit, the accounting profit, is 230,000. However, there was a change in the profit sharing ratio on 31st December 2022. So for the first 6 months, the profit sharing ratio, the agreement was that the profit will be split equally between each partner after allocating a salary of 20,000 per annum to Simon. So that was the decision. From 1st of January, the decision was made that James will receive an annual interest of 4,000 and Simon's salary would be reduced to 10,000 per annum, and the profit sharing ratio would change to 40, 30, 30. So pick up a 6-month profit. So 6 divided by 12. So that is a pre-change. So 6 divided by 12 multiplied by 230,000. From this one, you deduct Simon's salary, prorate the Simon's salary because the annual salary initially was 20,000. For the 6 month, the salary would be 10,000. So allocate that salary to Simon. So any residual profit of 105,000, split it equally. So that would Simon will receive 35,000, James will receive 35,000, and Lena will receive 35,000. Then deal with the second period and the second period. So pick up this 6-month profit. So 6 divided by 12 multiplied by 230,000. From that profit, so deduct Simon's salary. So the Simon salary was reduced to 10,000 after 1st of January 2023. So for the 6 month, it will be 5,000. And then James, from 1st of January till 30th of June, James was entitled for the annual interest of 4,000. So half will be 2,000. Initially, he was not entitled. If he would be entitled for the entire year of 4,000, so then you need to include that 2,000 in the first 6 months and the remaining 2,000 in the remaining 6 months. However, watch the wording. The wording saying from effect of 1st of January, James entitlement to the interest on capital, there's entitlement for £4,000 a year. So if you take 6 months, so 6 divided by 12 multiplied by 4,000, or you can do 4,000 divided by 2. Then also Simon's salary changed to 10,000. So halfway salary will be for the 6-month salary would be 5,000. So 115,000 minus Simon's salary of 5,000 minus interest to James of 2,000. Residual profit for the remaining 6 months is 108,000. Then split this profit on each partner using the profit sharing ratio 40, 30, 30. So that would give you a Simon income of 43,200 for the second period, 32,000 for the James, and 32,400 for Lena. Then add the total profit. So first allocation using the profit sharing ratio for each period. Then you have to add this total profit. So for the Simon, 10,000 plus 35,000 plus 5,000 and plus 43,200. Then deal with the James, 35,000 for the first 6 months, and then he has an interest received of 2,000, and then for the remaining 6 months is 32,400. So add the total profit. For Lena, for the first 6 months, 35,000. For the remaining, Lena was not entitled for any salary or any interest on capital. So the Lena, add the total for the Lena. So Simon will declare 93,200 on his self-assessment. James will declare 69,400 on his self-assessment, and Lena will declare 67,400 on her self-assessment. Finally, thanks for watching. I hope you found this video useful. Remember, once you have the knowledge, the examiner cannot trick you. You will also perform well in practice too. My aim is to give you confidence and knowledges you need for your exam and in practice. Hence, your chances of employability and passing your exam will be high. Do not forget to share, like, and comments. Also, hit the subscribe button because I'll be making more useful videos like this to benefit you. I have already uploaded so many videos on the YouTube which cover employment taxes, corporation tax, capital allowances, partnership. This video is about change in the profit sharing ratio. My next video will cover how you can deal with admission and if there's any partner retirement from the partnership. Also, I'll be making video on capital gain taxes, inheritance taxes, VAT, financial reporting, and financial management. Now it's time to wish you a pleasant day.